Hi, everyone. This is Dominic Marisigan, and I'm with Day Trade Asia. Now, this recorded webinar is basically going to give you some information on what futures are, and more specifically on what we trade, which is the ES or the S&P 500 E-mini futures. So before I start, here again is This is Day Trade Asia. And here's the disclaimer and risk disclosure that I need to present. So all information in this presentation is for educational purposes only and is not an offer or a recommendation to buy or sell futures, stocks, options, or Forex. The SEC, Securities and Exchange Commission of the Philippines, or SEC Philippines, required me to post this disclaimer. The trading of futures contracts in the Philippines, as well as the rules of the SEC Philippines on futures trading, is currently suspended. Thus, the trading of futures contract is not allowed in any Philippine exchange, for example, the Philippine Stock Exchange. The futures contracts that are subject of Day Trade Asia's training courses are exclusively traded in the Chicago Mercantile Exchange, or the CME, and are not traded, nor are these legally allowed to be traded in any Philippine exchange. So what we do is basically we speculate on the price of the S&P 500, and it's basically traded in the Chicago Mercantile Exchange. And also, SEC Philippines require that the trading of futures contracts is highly technical and complex and depends on numerous and variable factors. Thus, any investor or trader of futures contracts, experienced or inexperienced, could potentially lose all or more than his or initial investment. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not indicative of future results. And here is the CFTC. The CFTC, or Commodity Futures Trading Commission, is the regulating body of the CME. And it says here again, same thing I mentioned before: do not trade with money you cannot afford to lose. And any account that's being represented here is not really indicative of future results. Same thing here. Read that. And here's my history of my trading. So anyways, again, my name is Dominic C. Marisigan. I am the master trader here for Day Trade Asia. So I began my trading career back in 2010. I traded Forex for 3 years, and I found I was not consistently profitable during those 3 years. So I ended up also trading, dabbled in binary options. And I did that for maybe 2 years. Then I started trading futures back in 2013 when I began with Day Trading Academy. In fact, my mentor is the CEO of Day Trading Academy. His name is Marcello Arambidi. So currently I am now the founder and master trader of Day Trade Asia. I used to be the master trader for Day Trading Academy and also Day Trading Academy Philippines. This is Marcello right here. Let me do this. Here's Marcello, the CEO. This is the other master traders around the world, for master traders for Day Trading Academy. As you can see here, I was a master trader here in the Philippines as well in the US. I was teaching students online for the students in the US. So here is how I started with Day Trading Academy. See if I can get this. There we go. My name is Dominic. I'm from Chicago, and basically my background, I've been trading Forex for the past 3 years, And now I'm in the futures. I've been trading futures for the past year with another type of system. I was kind of basically unhappy. And now I've found Marcello in his day trading academy. And it's where you find your aha moment. And I found my aha moment, and I just started 2 weeks ago, and I know this is going to be very successful for me. And I'm transitioning to become a full-time trader. It's better than I expected. I learned a lot, and like I said, my aha moment occurred the second day. So basically, that's how I started day trading. I took Marcello's 5-day intensive training, and that's when I found that futures was basically what was my aha moment, as it said there. So what are futures? Futures is not about the movie Back to the Future. So here is a brief clip from the movie Trading Places, starring Eddie Murphy. Duke and Duke here, the older gentleman, represent a broker. They basically broker, and you'll hear what they do is basically trade to speculate on the price, if the price is going to go up or down on a particular commodity. We do the same thing. We speculate on the price. So here's just a brief clip from the movie Trading Places, and this is what futures is all about.
We are here to try to explain to you what it is we do here.
We are commodities brokers, William. Now, what are commodities? Commodities are agricultural products, like coffee that you had for breakfast, wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich. And then there are other commodities like frozen orange juice and gold. Though, of course, gold doesn't grow on trees like oranges. Clear so far?
Yeah.
Good, William. Now, some of our clients are speculating that the price of gold will rise in the future, and we have other clients who are speculating that the price of gold is going to fall. They place their orders with us, and we buy or sell their gold for them.
Tell them the good part.
The good part, William, is that no matter whether our clients make money or lose money, Duke and Duke get the commissions.
Well, what do you think, Valentine?
Well, it sounds to me like you guys are a couple of bookies.
I told you he'd understand.
So there, basically, we speculate on the price on the futures. Like I said, more specifically on the S&P 500 stock index. So what are futures? Basically, in the beginning, futures are basically a standardized contract for the purchase and sale of a financial instrument. Okay, so, or physical commodity. So the physical commodities, like you saw in that clip, was like orange juice, gold, silver, pork bellies, and so forth. Those are physical commodities. Usually when these physical commodities are bought, you are basically hedging on that commodity, okay? Whereas, as it says here, there are two categories of market participants. There are hedgers and there are speculators. We, as retail traders, are considered speculators. We speculate on the price movements of an underlying asset using futures. So we don't purchase any asset. We just speculate on the price. We do not purchase anything. We speculate on the price. So here's a typical example, simplified example of what are futures. And this is more of the hedgers. So for example, you have a Philippine coffee bean farmer here. He supplies or sells his coffee beans to Starbucks for 800 pesos per kilo. Okay, so here, this is what they would do, a hedger. For example, Starbucks are deciding to buy, okay, they'll be buying 20,000 kilos of coffee, and they want to fulfill that order within 6 months. So when they look at the futures contract, they see the futures contract is priced at 500 pesos per kilo. Right now, the current price is what they're selling at, what it says here, 800 pesos per kilo, right? However, the futures contract is pegged at 500 pesos per kilo. So they purchased that contract because what the thing is, they will be buying because they have a contract to purchase 20,000 kilos. So they went out to the futures market and found out the price for a 6-month contract is 500 pesos per kilo, which is cheaper than what they're paying right now. So by purchasing this futures contract, Starbucks guarantees a price of 500 pesos per kilo, right? And so when at the end of 6 months, they find out that the price of the coffee beans have increased from 800 pesos per kilo to 1,000 pesos per kilo. However, they were guaranteed a price of 500 pesos per kilo. So therefore, by purchasing that futures contract, it basically resulted in a greater savings or greater profit. So what happens here, it says here, if Starbucks had not purchased the 6-month futures contract, the price of coffee beans ended up increasing from 800 pesos per kilo to 1,000 pesos per kilo. The company would be forced to purchase the 20,000 kilos of coffee beans at 1,000 pesos per kilo, but they bought this 6-month futures contract at 500 pesos per kilo. Therefore, they made more money. So this resulted in a greater expense compared to the guaranteed buy. So therefore, they increased their profit margin because they were able to purchase the futures contract at a guaranteed price of 500 pesos per kilo. They bought it rather than the regular price of 800 pesos per kilo. Hopefully that's clear enough. So the other end of it is, let's say Starbucks is looking to sell, or let's say the Philippine farmer of coffee beans decides to sell 20,000 kilos to Starbucks, right? The current price is at what? 800 pesos per kilo. That's what the price they would be selling at. However, they went to the futures market and they saw in 6 months, the futures price is 600 pesos per kilo. So therefore, they would be guaranteed that price, selling price. So they bought that contract to guarantee them, the farmer, that they will sell their coffee beans at 600 pesos per kilo. So what happens is the farmer, when at that time in 6 months, the price of coffee beans dipped to 400 pesos per kilo. So rather than taking that full loss, you see the difference between 400 and 800 is what? 400 peso loss. Since they purchased the futures contract at the price of 600 pesos per kilo, therefore, instead of incurring a 400 peso per kilo loss, they only incurred a 200 peso per kilo loss. So in this case, the farmer, rather than Starbucks Philippines, because the farmer is selling the coffee beans to Starbucks Philippines, therefore they saved money. In this situation, instead of Starbucks Philippines, it's basically the Philippine farmer has decreased its risk that it will experience financial damage as a result of a steep decline in the market price for coffee beans in the future. So basically what they did was basically limited their loss. They were selling it currently at 800 pesos per kilo, and they were going to sell 20,000 kilos of coffee beans to Starbucks. And after 6 months, the price of coffee beans went down from 800 pesos per kilo to 400 pesos per kilo, meaning they lost 400 pesos per kilo. But instead of incurring a loss of 400 pesos per kilo, they only incurred 200,000 or 200 pesos per kilo a loss because they purchased a 6-month futures contract at 600 pesos per kilo. Does that make sense? Or is that clear for you, I should say? So basically, that's the simplified version of futures contracts in terms of hedging. Okay. Now, like I said, what we do, we don't hedge, we speculate, and that's it. So here are some of the other examples of futures contracts for agricultural commodities. They are wheat, corn, soybeans, and livestock. For interest rate, we also do futures on interest rate bonds. They have the 5-year bond, the 10-year bond, and 30-year bonds, and these are based on interest rates. We also can trade crude oil, natural gas, as well as gold and silver. And also those people who like to trade Forex, we have the futures currency futures, what we call them. Or no, this is the stock index. I'm sorry. Here are the currency futures, the euro, Japanese yen, the British pound, and so forth, all the major currencies. But what I teach is basically speculating on the price of the S&P 500 stock index, not individual stocks, but the stock index. Here's an example of a pit. We call it the pit. It's the Commodities Pit based in Chicago. And if you saw that movie Trading Places, this is where they would buy and sell commodities, and they did that by what you call hand gestures. It's all signaling. They don't yell. You can hear some yelling, but you will see a lot of hand signaling. So that's what they did. I believe in 2008, they got rid of the pit, and now most of these traders are now trading online, or they're trading electronically. So the E-mini ES, as you can see this symbol, is a futures contract that tracks the S&P 500 stock market index. Okay, that's the index. The S&P 500 stock index is a collection of the top 500 blue chip companies in the U.S. That includes Apple, Google, Microsoft, Exxon, what else? Amazon, so forth. So this is a benefit for day traders like us, as we don't exclusively study one stock, one specific stock, but we basically speculate on the movement of the price in the markets as a whole, meaning the index. Okay. And this is traded this whole thing is traded in the Chicago Mercantile Exchange, or the CME. And it's also traded electronically through the Globex trading platform. And why was the E-mini formed? Because to allow individual traders like us to participate, to trade in the Chicago Mercantile Exchange. And this was basically established in 1997. So a regular ES contract right here is basically right now, let's say the price, right now the current price, I'm looking at my chart, is around $36.95. Right now, let's say it's at 3,600, right, the index. That means the current market value of one regular ES contract would be $180,000. Since most of us retail traders don't have that much money to trade, we basically what happened was the E-mini was created. The mini version of the regular ES contract is 1/5 the size of the regular ES contract. So therefore, 180,000, therefore, would be 1/5 of that. So you take 1/5 of 180,000, and I don't really have my calculator here, divided by 5. So it's $36,000. So the mini version is 1/5 of that, would be 36,000, which is more affordable than 180,000. And therefore, it is more accessible to retail traders like us with smaller amount smaller account to trade with. So again, the E-mini S&P 500 or ES is the most traded financial instrument in the world. It averages around 2 million contracts daily. And you can see here, the tick size, and we'll explain what tick size is. The world's most actively traded stock index is the ES. And like I said, 2.2 million contracts traded on an average day. So what is a tick chart? So what is a tick? So it says here, one tick. One tick is an incremental movement. So for example, from 3119 here through 3119.25, you can see that's one increment movement or 25-cent movement. Each increment is 25 cents, but each increment is one tick. One tick equals $12.50. So therefore, any movement either up or down is $12.50 per tick. So for example, in this one, 3119, a move from 3119 to 3119.25 is equal to $12.50. Understood? Same thing, 3119 to a move down is to 3118.75 will equal, again, $12.50. So if you look at this, if you have a movement in the index from 3119 to 3120, which is a $1 movement, that equals a $50 profit. So $1 equals $50. That's $12.50 times 1, 2, 3, 4. It's composed of 4 ticks. So here, a $1 movement in the index, 3119 to 3120, is composed of how many ticks? 1, 2, 3, 4 ticks. 4 times $12.50 is what? $50. So that is the leverage on the ES. $1 equals a $50 leverage. And here are the following tick values for the specific other futures financial instruments. For example, the NASDAQ is $5 per tick. The Dow Jones Industrial Average is $5, and the Russell is $5 per tick. And here's your currencies. There's your specific tick values and so forth, as well as gold and silver. So there are two types of people who invest in the market. There are investors and there are day traders. We are day traders. So investors are in the market for a long haul, often waiting months or years to make the money. That's like real estate or even the Philippine Stock Exchange or the Philippine stocks. People usually profit or wait for their profit after holding it for several years, right? And that's why a lot of investors place their retirement or savings account into the stock market or the mutual fund market and so forth. Because the simple premise is that the market will either go up over time and they will be profitable in the long run. Whereas day traders, that's what we do. We see our profit or loss on a daily basis, as we are in the market for as little as a few hours. Again, that's why it's day trading. The principle of day trading is to make money off the fluctuations of the market. The fluctuations are either going up or the fluctuation going down. Again, we make money if the market is going up or down, either way. Our focus then is understanding price action and momentum. It's no longer when it's no longer necessary to spend hours on research in terms of, like, for example, stock traders or even Forex traders. They have to look at not only the sentiment of the market, they have to look at news articles and so forth to determine how it's going to affect the market that they're trading or the stock that they're buying and so forth. It takes a lot of research. Whereas when we start doing our day trading, we basically do a 5-minute market analysis to determine where the momentum is going. And we trade according to that momentum, either up or down. And that's all we need. to really start trading. Again, our trading time is usually between 1 to 2 hours per day, and that's it. Once we reach our target profit or our should I say our daily loss as well, we stop trading. Okay. Our earnings are immediately available in our segregated accounts, and we can withdraw anytime we want. So why trade E-mini ES futures? First of all, it's easy to get started. To open up an E-mini ES futures trading account, you need to deposit anywhere from between $1,500 to $2,500. I recommend $25,000 to $5,000 for beginners. Okay, the margin requirement is $500. That's just for Ninja Trader Brokerage, which I personally use. I'm not an affiliate of that brokerage. I basically just trade with them, and I'm not affiliated with them. I am not affiliated with them in any way. And their margin requirement is $500. So what is a margin requirement? What is a margin? So basically what a margin is basically it's like a fee to basically begin trading. Let me see if I can find a good example here. So let's say we started off with a $1,000 account, right? So we entered a trade. Once we enter a trade, let's make this 500. Once we enter a trade, that margin will be subtracted, okay? That margin will be subtracted from our account. So therefore, our trading funds available for trading would be $1,000, right? So let's say we made profit on that trade of a profit of $100, right? Let's say we made a profit of $100. So therefore now our trading account is now $1,100, correct? Following me? So once we close that trade out, we then see this $500 margin will now be, it was taken away from our account, will be added back to our account. Therefore, our account balance now would stand at 1,600. So that's what margin is. It's basically I always consider it as an entrance fee to be able to trade in the Chicago Mercantile Exchange. Once you get out of that market, or once you end that trade, that fee is rebated or refunded back to your account. Clear? So that's how margin is used in futures. Okay. Hopefully that's clear enough. So anyways, as we go through here. Now, May of 2019, was it 2018? No, May 2019, the CME introduced the micro ES as compared to the E-mini ES. The micro ES is basically 1/10 the value of the E-mini. So therefore, instead of requiring a minimum deposit or minimum investment of $2,500 to start trading, it only requires between $400 to $500 investment or deposit to trade. And their margin requirement is only $50 per contract. Again, that's with Ninja Trader Brokerage. Another one, the other reason I trade, good way why you would like to day trade E-mini futures or E-mini S&P is because, again, the volatility. There are 2 million contracts a day, meaning there's great price action, and again, volatility. You need volatility to enter in and out of any trade. Whereas if there is a lack of volatility in the Philippine Stock Exchange, you can't really day trade any stocks in the Philippine Stock Exchange because it lacks a lot of volatility, low liquidity or low volatility as compared to the ES futures. So again, I explained about the micro ES futures. It's basically 1/10 the size. So like I said, one tick on the E-mini futures is $12.25. On the micro E-mini, it's only $1.25 per tick. It's basically 1/10 the size of the regular tick on the E-mini. Again, here, what I like about the E-mini ES features is basically it's very transparent. These are what we call level 2 data. You see the number of buyers or the number of contracts being sold at this particular price in the price ladder, and you have the number of buyers, the number of contracts that's being traded right here, or buyers at that particular price. You don't see that in Forex because you see this in the U.S. stock market, and also maybe I think in the Philippine Stock Exchange. That I don't know because I don't trade Philippine stocks. But in Forex, you don't see this level 2 data because there is no volume. And with E-mini ES features, it's a level playing field, meaning it's centrally regulated. It's a regulated exchange. Therefore, as you can see here, you can see the 10 best bids or 10 best asks. The bids are the selling prices and the asks are the buying prices, along with the associated volume in real time. This is the volume right there. So that's why it's considered level 2 data. This transparency of the market orders allows ES traders to see where and how many orders have been placed ahead of them. So day trading is basically a zero-sum game. If we lose money, we are basically giving it to another trader. If we make money, we are taking money from another trader. That's what a zero-sum game is. You cannot have all losers and all winners in that market. So therefore, if we make money, we basically give it to another trader who won. That's what a zero-sum game is. So we can make money with trading ES futures. We can make money when the market is going up, when the market is going down. There are no short sell restrictions like you do in the stock market. I think in the Philippine Stock Exchange, there are some short sell restrictions, whereas in futures, there is none. Again, low prep time. No, we only do the pre-market analysis. It only takes maybe 5 minutes. That's about it. Again, high leverage. For every $1 market goes up in the S&P 500 or the ES, we can make a $50 profit in that $1 move. So there's a leverage of 50 to 1. Again, the low commissions. Right now, the commission is basically it's $3.98 per trade per contract. Okay, that's fixed. It never fluctuates. It's fixed. Again, the spread, if we do a market trade rather than a limit trade, the spread is only 1 tick, or basically $12.50, and that is also fixed. It never fluctuates. It's fixed at $12.50 or 1 tick. And there is there's no pattern day trading rule. Now, like in the U.S. stock market, to day trade stocks in the U.S. stock market, you would have to have at least a minimum of $25,000 in your fund. Okay, I don't know if they have it here in the Philippines. That I would not know. You stock traders would probably know more than I do. So here's your typical commissions. So this is basically $1.99. So you take that times 2 because when you enter a trade, that's one entry, and when you get out of the trade, that's another payment. So therefore, one complete trade is $1.99 times 2 is $3.98. So that's your commission. Here are the commissions of your other financial instruments, your future financial instruments. Like for example, the future command or future currencies right there. So you're there, and also the other indices. You have the Russell, the Nasdaq, I think the other one should be the Dow. Yeah, I think it's another one here. You can see all here. Okay. So the reason in Forex, okay, this is Forex. First of all, Forex is a decentralized exchange. Therefore, there are various fluctuations in the price. And so there is also manipulation of the price as well. So as you can see in this article by CNBC, this is in May of 2019, Barclays, Citigroup, JP Morgan, these are more of the institutional traders or the banks that were fined. They were fined $1.2 billion for rigging the Forex price. And they basically pleaded guilty. You know, they're basically saying, okay, you caught us, we'll pay the 1.2 billion. And the reason they have no qualms about paying $1.2 billion is because they make billions and billions of dollars in the Forex market. All these institutional traders or banks, that's how they make a lot of money. Here's another one. Again, like I said, Forex is the largest market in the world. It's $5.7 trillion. And unfortunately, it's the most manipulated market as well. Here's another article by CNN Money. HSBC to pay over $1 million for cheating their clients in terms of Forex clients. And that's why I don't trade. I traded it at one point, and I really never really got consistently profitable in it. So the advantages of trading of futures, or I should say Forex, okay? Low cost to get started. You can start off with $50 or $100 to basically start trading live. Low prep time. You only require technical analysis. And also there's high leverage also on Forex. You can go up as to maybe 100 to 1 to maybe as high as 500 to 1. And also it's easy. It's an easy market to learn. The disadvantage of it is there's higher risk because of the leverage, high competition. Your competition is between the hedge funds, the banks, the institutional traders, and so forth. And also the bank, or should I say the government intervention, because the governments are the one who basically pegged the value of the exchange rate or the exchange rate of the dollar or your currency. And again, there's no price transparency since it's not a centralized market. You basically have 5 different markets. You have the US market, you have the Euro market, you have the London market, you have the Australian market, and you have the Asian market, which is the Japanese market. Okay? So that's why there's no price transparency, because it is decentralized. Advantages of stocks. You have a lot of stocks to trade, lots of public information available for each of the stocks or each individual company that you want to invest in. The disadvantages is that in the US, you have a $25,000 pattern day trading rule, meaning you need to record at least $25,000 in your account. Again, I don't know if there's such a thing here in the Philippines as a pattern day trading rule. It's very time consuming to do research on each individual stock. And again, there are some short selling restrictions in trading or selling stocks. And there is also some market manipulation that's going on in terms of in the stock market, especially here in the Philippine Stock Exchange as well. That's what a lot of some students have told me. Again, the biggest disadvantage here in the Philippines is there is low volume or low volatility to adequately day trade. So now, in terms of advantages for the futures, there's low cost to get started. Again, if you decide to trade micro E-minis, it's $400. If you're looking to trade the regular E-minis, it's basically $1,500. For beginners, I would recommend anywhere from $2,500 to $5,000. It's a level playing field, zero-sum game, meaning if you win, you're basically giving it, there are winners and losers. If you're winning, there's a corresponding loser on the other end. That's what a zero-sum game is. Low prep time, again, it only requires 5 minutes of your time to analyze the market. And there's also higher leverage, especially in the ES. This is more specific to the ES, right? So it's basically the leverage is 50 to 1. Easy market to learn, and there's no short sell restrictions. Disadvantages, again, since there's some leverage being used here, there's some high risk. And also, we're also competing against the institutional traders, the hedge funds, and so forth. And that's what the advantages and disadvantages of trading E-mini futures. So here is a typical trade. That's why I like an example why I enjoy trading futures. And this is basically trading two contracts, right? So as you can see here, we look at this chart, the trend is basically going down. So we speculate that the price will further go down. And I have here, let me explain this as this goes down. We can do maybe one or two trades, we'd be good. And I don't like these erratic movements that's going on. So we will see what's going to happen here.
Order submitted.
So there, I'm speculating the price will go down. I did a limit order here, or what a pending order is. I speculating the price will hit that there. It filled my trade. And once it fills that trade, it automatically puts a stop loss and my profit targets automatically, as you saw there. So my stop loss there, if the trade goes against me, that's my loss, my limit, or should I say my loss? I would limit my loss. So here I'm approaching my first target, which is basically, here's I'm trying to get to my second target. You can see this whole trade took less than 15 minutes, right? Let me further this. Let me get this further down here. It's going down. It eventually get down there. It's taking its time though. So I think I got that. That's 575 gross. Should be good in terms of my net. So you heard that $575 gross. That trade, as you saw there, was $575, and it took less than what? It took less than 5 minutes you can see here, less than 5 minutes, or even less than 15 minutes to make $500. I was only trading two contracts. Now, if I was trading one contract with my first profit goal there, it would have been at least $300, I think. Yeah, because it's around that much. So that's why you can easily make $100 a day on one contract. That's why, and that's within 1 to 2 days or 1 to 2 hours of trading. We usually get done within 1 hour. Again, that's the reason why I like basically doing that. What it is. So we're looking. Let me see here. So here's another example of some trades. This was November of 2020. As you can see here, I made $1,500 trading only two contracts, and I started. Here's the entry time was at 5:02, done within 1 hour. Made what $1,500 in this particular case. It was around 1425, I think it is, right? 1,425 on that one trade. That took less than 1 hour, and that's on two contracts. Here's another one example. This was on, as you can see, this was on November 2nd. This is on November 3rd. Again, from 304 to 339. It's approximately what, close to 30 minutes, around 30 minutes, we'll say. I've made around 537.50 times 2, so that's what, 1,000, whatever, 1,100 something, right? Oh no, I made for the day 1,175. This particular trade here, where it took less than 30 minutes, I made over $1,000. That's actually pretty good, wouldn't you say? And that's the opportunity that you have. So I basically, and that's the reason why I trade futures. I basically have a course. It's called Gold Membership Course. It's a 3-month course. I basically teach my students the strategy to trade to profit consistently. Money is made according to that strategy, the legacy strategy. Money is made stalking and not forcing a trade. So it provides traders the best opportunities to enter a trade, and that's what the legacy strategy is all about. And that's taught during my Gold Membership Course. It's a 3-month course. It's an online course. We do it through Zoom. And what you will learn in the 3-month Gold Membership Course is this. You'll learn how to be consistently profitable as a day trader. Again, it's 3-month course, 3-month access to online curriculum. What you learn is basically the basics of E-mini futures and the introduction to the legacy strategy and the tick chart. We use the tick chart rather than a time-based chart. You will know the market anatomy, meaning how to determine the momentum of the market as well as direction shifts. The legacy trade setups, basically there's 3, the V1, V2, and V3. You develop trading skills by trading in the live market with a demo account. You'll be able to communicate with other fellow traders in a chat room. Basically, the chat room we use is Telegram, and so you'll be able to communicate with your fellow traders as well, fellow students, and you also at the end of that course, you have an opportunity to become a proprietary trader, meaning you'll be funded rather than funding your own account. You'll be funded by a prop firm. The minimum amount to be funded is around $25,000. So you'll be funded $25,000 to trade. That good. So here is about day trading. So day trading is not, like I said, the expectation of being a full-time day trading is this. Day trading is good. It's not for everyone, but it's good to know how it works in a practical term. And I believe everyone can learn to trade, but not everyone has the discipline or patience. I have a majority of my students have quit trading because they thought that earning money trading is very fast, that by the end of 1 month, they'd be able to earn money. A majority of my students do not do that. I have some students who have learned within the 3 months that I'm teaching, and they've been funded. I have one particular student, I'll show you that example. But anyways, there are no shortcuts. You either work hard or you practice, and you practice or you don't. Most trading academies make you believe that by buying a course, you'll soon become a professional trader and earn a lot of money. Be careful. It's not that easy, and that's what I always tell my students. If you do it well, if you really put time and effort in it, you will learn how to trade, and you might even become profitable. And if you do it well, you can earn a lot of money, and basically be a lifestyle change. Yes, you can make a living out of trading, but again, you have to be consistent. You have to put that time to become or develop to become a consistently profitable trader. So in my opinion, you can make a lot of money with day trading, but only if you really focus and are ready for a change, because trading is more of a mindset rather than reading a chart. It's 90% psychological, 10% technical. So most people are not willing to really challenge themselves and take control of their emotions. The emotions that we deal with as traders are greed and fear. Although we don't hear a lot of failures, we see a lot of people do lose a lot of money, and that includes myself. I've lost a total of $100,000, and I always consider that as my if I went to college, that would be my tuition to learn how to be a successful trader. So basically, I lost $100,000, and that's why my aim is to basically be transparent with my students and evaluate the way they trade their demo account. Once I determine that they are consistent with their demo account, then I will tell them that you can go ahead. I would tell that particular student that you can go ahead and either fund your own live account or test to get a funded account. Once I determine that you are consistently profitable in your demo account, okay, rather than you start losing as much of the money that I lost, right? So again, that's what futures is all about. And if you are interested in the 3-month gold membership course, I will provide a link, and I will do another, should I say, a short video on that, explaining more of the details of what the 3-month gold membership course is all about. Okay, so if you're interested in the 3-month gold membership, I will provide a link to view that video to get more details of what the 3-month gold membership course is all about. Okay, so thank you for your interest in what day trading futures is all about. And hopefully, if you have any questions, you can hit me up also with the email that I will provide. Thank you for your time. Take care. God bless. Bye-bye.